Everybody okay? I know this is confusing. This is one of the most confusing part of the course. But I told you we'll pick up rhythm as time goes on. Right. Now, the third statement is very powerful. If all the investors have homogeneous expectations, they all say the same lending and borrowing rate, then everybody will have the same graph in front of them. Everybody will have the same graph in front of them. This graph. If everybody has the same expectations, they all have they all have the same expectations. And they all see the same. If they all see the same, all see the same rate, borrowing and lending rate. And the main statement over here is if they all have the same homogeneous expectation, they will all see the same graph. The same line being AC, the risk-free rate line, and the same portfolio of all risky assets, PI. PI is a market portfolio. It includes all the risky assets. Now, investors will decide based on their risk averseness where do they want to be on the line. Do they want to borrow and put more money on PI? Well, everybody will invest in two things. The market portfolio, which is PI, which is tangent on the point, is the efficient part of the frontier, DC. Or do they want to lend and invest the remaining money in the market portfolio? Do you want to be on the line above PI or below PI? That depends upon how risk averse individual person is. I could be below PI and this chap could be above PI. But me and him and everybody else having homogeneous expectations of returns and investors, we are all facing the same one rate, risk-free rate. We will all see this graph in front of us. And that market portfolio becomes very, very crucial. In equilibrium, PI is a market portfolio. What is a market portfolio? How does it define that? How do you define market portfolio? If you go to back of Wall Street Journal and Financial Times, you will see different portfolios sometimes. And they do have a market portfolio. And if you go to DataStream, and some of you will be going to DataStream in the summertime, download data for your dissertation. You may already do this for your assignments in different courses or whatever. And MCIS and S&P create a market portfolio. Market portfolio, in theory, includes all the assets in the market. Market portfolio, in theory, includes all the assets in the market. And the weights are according to the weight in the total market. If IBM represents 1% of the market value, then market portfolio will include 1% of IBM shares. If Coca-Cola represents 1.5% of the total market value out there, then the market portfolio will include the weight will be 1.5%. Remember the weights? X. This is percentage. How much of stock A belongs there? How much of stock B belongs there? Will be based entirely on market. Will be based entirely on market portfolio. So if asset one controls 1% of the total market value of all the risky assets, then market portfolio will come. The weight of that asset in market portfolio will be 1%. If some stock controls 5%, which is a big chunk of the market portfolio, of the market value, total market value, which is a big chunk of the total market value. If it controls 5%, we have the room for this time. We have the people are looking at it. We have the room for the whole today. So again, oh, she's late. She's not coming in. So of the total market portfolio, the weight in the market portfolio will be 1%. Investors will buy only risk-free assets and only for the market portfolio. If you are very risk averse, then you will lend and put most of your money in very little of your money in market portfolio. If you are very little risk averse, then you are going to borrow. If you go back to the graph, this graph, I want to go back to the graph. People are going to be on this line. Investment here in PI and the risk free there. That's what it's going to be. Borrowing or lending and putting money here. If I'm somebody who's very, very scared, very risk averse, where would that person be on the line? Above? Below? How below? High? What? Somebody who's very, very scared, extremely risk averse. Where will they be on the line? Below or above PI? How below? Can somebody be here? Can somebody be here? Yes, that is all the money in the risk-free asset. They'll lend everything out. They're very, very scared. And as you move on this line this way, you are moving money out of risk-free asset into portfolio PI. And once you cross, not only you move money out of your risk-free asset, you're borrowing money from that and putting it into PI. The least risk averse you are, the higher on the curve you are. The least risk averse, the most risk averse, you're further down there. Over here, you don't want to play the market portfolio, you're too scared. So to go up and up, where this investor will end up, where I will end up, where this investor will end up, depends upon how risk averse they are and how risk averse they are not. But everybody has two choices, invest in this guy and the risk-free asset. And because of that, this line is known as capital market line. This line is known as capital market line. Now, because it's a two-fund investment, there are only two funds you can invest in, risk-free asset and market portfolio. So this theorem initially was known as two mutual fund theorem. That's what they called it. They never called it CAPM. CAPM was given later on. Their paper actually calls this two mutual fund theorem because all investors are happy by investing in market portfolio and the risk-free asset. Some are more happy by borrowing and putting more money in the market portfolio, and some are more happy by lending and putting less money in the market portfolio. Some who are very, very scared put everything in the risk-free asset. So it's not there are two assets. And this line is the capital market line. Right, they of course were not happy with this. And that's the equation for the capital market line. Rm is the return on the market portfolio. And that's the variance of market portfolio. So Rm is the return on the market portfolio. And is the variance or risk of the market portfolio. Variance and risk of the market portfolio. RE is the expected return of portfolio, of your portfolio, and that's the variance of the portfolio. So all there in the paper. Which is the intercept? This equation of the line again. Which one is the intercept? RF is the intercept. RF is the intercept, right? And the slope the slope is equal to that. You have the slope here, right? And that is the slope. That's the slope. Is that positive or negative? It's positive, of course, because the return on the market portfolio has to be higher. It's a risky asset. It's a risky portfolio. So it's positive. The deviation of Daniel is positive also. This is the price of risk. This is the market price of risk. This is the market price of risk. If you look at the equation, look at the equation up there. If standard deviation RF is positive and the slope is also positive, right? They're both positive. So the intercept is positive and the slope is positive. If the standard deviation of the portfolio, sigma squared E, increases, what will happen to return? Return will increase. But by how much? If the standard deviation increases by 5%, the standard deviation goes up by 5%, how much will the return go up by? We know the return will go up. We know that. We know this will go up, but the question is, by how much? How much will the return go up by? Who will dictate that? Who will decide how much will the return go by? Look at the equation. Tell me, don't give me a number. Tell me, you can't give me a number because there's no numbers up there. But if standard deviation goes up, return will go up. But who will decide what the relationship is? We know RF is positive, and we know the slope is positive. So standard deviation goes up by that equation, which is risk. If risk goes up, then this return has to go up. And who decides that? Yes?
It's a question.
Okay.
Can RF be negative with deflation?
Deflation negative. You may, but nobody will invest. Return is negative. Who's going to put money? It will disintegrate that. The market price of risk, the slope will decide that. How big it is. The market price, if you look at the equation, how much return will increase will depend upon the risk-free rate, which is the intercept, and the market price. The slope is the market price for the risk. It will directly control how much return goes up by. How much are you willing to pay? How much is the market willing to pay to you for taking this risk? That's what it's going to tell you. That's what it tells you. That slope tells you how much is the market willing to pay for this risk. If the risk goes up by 5%, how much does your return go up by? That's your reward for taking this risk. If the risk goes up by 5%, there is a one-to-one relationship. If the return goes up by 5%, there's a one-to-one relationship. If the return goes up by 3%, it's giving you less than the rise in the risk. That slope is the market price of risk. It tells you how much do you actually get by taking this investment on. The extra return can be gained by increasing the level of risk on an efficient portfolio by 1 unit. That is important slope. But they were not done yet. This was just the beginning of the theory. Then they make this comment. Then they say, okay. Okay, look at that equation. Look at the slope. Look at the risk. Tell me about that. top part, Im minus Im is positive. We know that's also positive. So the slope is positive. It's up. The line goes up. And that is the market price of risk. But they looked at this and they said, there's a fundamental problem here. That's the old theory. Capital market line, C and L, is the old theory they were trying to change. And they came and said, here's the problem. Should I bring an umbrella next time? Yes. So they said this is total risk. This is total risk. This guy is total risk. Standard deviation of market portfolio is total risk of the portfolio. He said, no, we don't want that. Total risk is not what we're concerned about. It's a part of total risk that we're concerned about. And they said, we all know a well-diversified portfolio does not have unsystematic risk. Unsystematic risk is disappeared. Systematic risk is the only one we should be concerned about. Total risk is equal to systematic risk plus unsystematic risk. Total risk equals systematic risk. This is not a problem. This is not a problem. We should not be concerned about this. Because this can be diversified away. We should be concerned about systematic risk. And they said that part, this part, should change. The measure of risk should not have total risk in it. The measure of risk should have systematic risk in it, not total risk. And they called total risk, systematic risk, beta. And they gave systematic risk a name, Greek name, beta. They called it beta, and I'll tell you in a minute what is beta equal to. They said systematic risk is equal to beta. And systematic risk of a portfolio, beta of P is no different from weight of 1 beta of the first stock, beta of the second stock, and onwards. So the beta of a portfolio is just like the return we did last week. The beta of a portfolio, the systematic risk of the portfolio depends upon what? Depends upon two things. This is the beta of the portfolio. Depends upon what? What are two things it depends upon? Beta of the individual assets in the portfolio and the weight of the assets. Beta of individual assets and weight. Just like return, if you remember return equation we did last week and this earlier today in the morning, the return depends upon expected return of each individual asset and the weight. This is beta of a portfolio depends upon individual assets. 1, 2, 3, 4, and the beta. Each asset will have its own beta. Each asset has its own standard deviation. Each asset has different total risk. Each asset has different total systematic risk. Each asset has different total unsystematic risk, which should not be a problem. So each asset has their own beta and own weight. And that creates the beta of the individual portfolio. Now, so what? So we go back to equation 1, which we did last week. Expected return. Once again, two assets, A and B. Two risky assets. A and B. Right? Two risky assets, A and B. Weight of A is X, weight of B is 1 minus X. Understand that? This is the same equation we did this morning and the equation we did last week. Weight of A equation 1 is quite standard. We did that before. Now beta is equal to that. From there, beta of this portfolio between two risky assets A and B is equal to that. Beta is weighted average, just like the return equation 1, beta is also weighted average. So beta, you're with me? You all with me? The beta is exactly the same. Now the return, so the beta is x, xa. This systematic risk of B, systematic risk of A, that's the weight of A and the weight of B, and they are the beta of the portfolio. Just like the return. And from here, you get the value of x. I don't want to do this in the board. From here, if you open things up, you get the value of x. Can you see from that equation to this equation? Simple algebra. Right? Simple algebra. You go from beta of b equal to that equation over there in the whiteboard to x equal to that. That's 3 or 4 steps. It's very easy to do. Okay? That's x. What do you do with this x now? Equation 1 over there has x in 2 places. Equation 1 over there has x in 2 places, right? You stick that x we just found into that equation 1. You get something like that. Now, that is the equation of a line. R see that? That is an equation of a line. And that is equation 1 from the previous slide with x equal to that number. Right? But if you look at that equation over there, the RP equal to that big monstrous thing multiplied by RA plus 1 minus that big monstrous thing multiplied by RB, right? That is not this line. That is not this line. That line does not show relationship between RP and beta. It doesn't show that. So that first part is not A, and the second part is not B. That's not the intercept, and that's not the slope. We need to do some more calculation to find what is A and B is. And for extra point, let's see you do that. Bring it next time. Okay, write your name on it. Make sure. Don't do it. Don't cheat from each other. Now you work together if you want. And show me what is equal to A and what is equal to B. Relationship has to be between RP and BP. Okay? Find me this relationship. Find me the value of A and value of B. Giving a relationship between return and beta. From that thing above. Now, we'll worry about the line later. Now, when we solve that equation, which you will solve this equation for extra points in the exam or assignment, tell you what, each group do their own one. I don't have to read 20 million of these, right? Each group does one, brings to me next Monday, and I'll give you extra points on the assignment. How's that? Fair enough? What? What is it? You want your own points for the exam, don't you? Ain't gonna watch. So, if the assignment groups don't do it, then it's fine. Okay? It's easy. It's mathematical algebra. Sit there and do it. You can solve it in less than 1 hour. That equation over there, these already see. This equation over there is that line. is now what? Systematic risk. There is no more standard deviation there. There is no more variance. It's down to beta. It's down to beta. There is no equation there anymore. There is no standard deviation. There is no total risk on the horizontal axis. We are measuring the relationship between expected return and beta now, systematic risk. They removed total risk and only kept the systematic risk. And they found an upward sloping line. So the B must be positive. The B that we find must be positive. The A must be positive also. It's an upward sloping line. Now, on this picture, everything is on the line. Every asset has to be on the line. It has to be. Otherwise, position D and E is not possible. How can they have the same systematic risk and different return? Nobody wants D. It's giving too less return for the same risk. No, everybody wants C, giving you high return for same systematic risk. Demand for C will be very high, and demand for D will be nothing. D price will have to fall for it to sell. C price will go up because too many people want it. If there's a long line for milk for no reason, price of milk will rise. Demand for C will be very high and demand for D will be very low. And arbitrage will make sure C comes down and D goes up, and they will both end up in A. All assets in the long run have to be at equilibrium. All assets have to be on the line. When market is equal to each other, supply and demand equal to each other, all assets have to be on this line. They can fall off for a minute or two, they can fall off for a short duration. Suppose asset C was on B and goes to E, jumps to E. What will happen? For some reason, asset E was sitting on top of B, falls off and ends up in position E. What will happen? For a short duration of time, few hours, I don't know, couple of days. Market is disequilibrium right now. Everybody would want that. Every broker will notice that this guy has same risk as other assets, but is giving higher return for some reason. It's fallen off the market. It's fallen off the line. Every broker will buy this. Every company will try to grab it. And price will shoot up for this asset and will come down to D. Similar to D, if somebody falls off to D because bad management or bad report, or they have not given enough the dividends over the last couple of months and price has fallen down, they come off the line, demand will fall for these guys. Nobody wants to buy D. They have to really sell cheap to come back to the line. And they will, otherwise they won't exist. D and E are not attainable. That line is not attainable. Short selling will take place. Short selling will take place. Beta of market portfolio is what? They just assume that. They just assume beta of market portfolio is what? That's beta of market portfolio. One doesn't mean is high risk or low risk, it's just one. Why do they do that? Why don't they just come out and assume beta of market portfolio is what? Why don't you say 1.5 or 9? Why do you say 1? They came up with it. Nobody says beta portfolio is 1, but they came up with it. Why did they do that? They did it for the sake of comparison. Beta to compare. Beta of A will be compared to beta of B. If A is higher than B, it's more riskier. But how much riskier? If A is 1.5 and B is 0.5, that means A is more riskier than market and B is less riskier than market. So beta of A1 given the market portfolio was done because of pure comparison. And we'll see some examples of that. Now equation, that's the same equation over here. If beta is equal to 0, what does that mean? If beta is equal to 0, what does that mean? Zero systematic risk, right? Which asset has that? Which asset has zero systematic risk? Which asset has zero systematic risk? Risk-free asset. So risk-free asset, beta on F is equal to 0. So RF, return of risk-free asset is A plus B multiply the beta of F. Where beta of F is equal to 0. So this goes away up there. So RF is equal to A. Every asset has this equation. Every asset has this equation. Every asset. Asset 1 to asset n has this equation. Every asset has a relationship between its return and its systematic risk. Every asset, whether it's UK bond or IBM stocks or Coca-Cola stocks or whatever, every asset has its own equation that explains the relationship between risk-free asset, the relationship between is beta and expected return. That's the equation for the risk-free asset. But the beta is equal to 0. So this part is gone. So RF is equal to A. Similarly, market portfolio has similar equation. But market portfolio beta is equal to what? What? Beta is equal to 1. So this guy is equal to A plus B. Right? That's 1. This is equal to 1. A plus B. Right there. What's B equal to that? B is equal to Rm minus A. Right? You with me? Are you with me? What is A equal to? So B is equal to Rm minus Rf. And that's the equation. Right there. A is a risk-free asset and Rn minus Rf is this way. Equation 2 is known as security market line. Equation 2 is known as security market line. They took the capital market line and made it into security market line. It shows the relationship between beta and return. If beta increases, return will. Why? Is A positive or negative? Is A positive or negative? Is B positive or negative? Is this thing positive or negative? Because the return on the market portfolio is higher than the risk-free rate. So this is positive also. So basically, if beta increases, return has to increase. But by how much? That is dictated by Rm minus Rf. This is known as higher the beta, higher the expected return. The relationship between is linear. So what does this equation say? What security market line shows is that beta is equal to what? And this is the definition of beta. Beta is equal to covariance between risky asset I and market portfolio and variance of market portfolio. Covariance between the risky asset I and market portfolio divided by the variance of market portfolio. And this is written as, in mathematical terms, sigma I and sigma square I. Okay, given that, why is the beta of market portfolio equal to 1? The beta of market portfolio is equal to covariance between market M, return of market M, and return of market M divided by the variance of market M. Right? It's basically equal to covariance. Right? That's the beta of the market portfolio, just the market portfolio. When each asset has its own beta, its relationship with the market portfolio. Each beta shows the relationship with the market portfolio. Covariance, if you remember covariance from last week, is the measurement between the relationship between A and B. Variance is dispersion. And this is equal to 1. Why is that? Any mathematician? The covariance between by itself divided by the variance. Covariance between A and A, covariance between A and A by itself is equal to variance of A. Covariance between the same two variables is basically the variance of that variable. That's the mathematics. That's not finance, that's math. So covariance between X and X is equal to variance of X. These two guys are the same. They're equal to 1. Now, suppose the beta of A is equal to 1.5. Beta of B is equal to 0.5. Beta of the market portfolio is 1. Can you tell me about this? What is the relationship here? What's going on here? What can you tell me about those three numbers? Very quickly. You got it? Beta of A is 1.5, beta of B is 0.5, and market beta is 1. How would you describe this? If I give you this in a short question, can you describe what's going on here? What does that mean? What does that mean? What does that mean? It means A is more riskier than market and more riskier than beta B. His beta is higher. But B is less riskier than the market and less riskier than beta A. Of the three, B is the most riskiest, has the highest systematic risk of 1.5. B has the lowest systematic risk of 0.5. Highest systematic risk, lowest systematic risk. This is even more riskier than the market. Right? Some broker, if you're a broker and call a broker and they say, oh, this stock is more riskier than the market. That's what they mean. The beta is higher than the market. This is less riskier than the market. And A, who is paying you the highest return? Who do you expect to pay the highest return? A, it's the highest risk. If you go by that equation, it's the highest risk. Now, if you take the definition of of beta and put it in equation, earlier equation. And put it in here, the equation 2 dash. If you take this definition of beta, you get equation 3. Equation 3 and equation 2 dash is the same because beta is defined as that. Everybody with me? It's complex, there's something to think about. I want it down as much as I can. That is important. That's something you must remember. Not just for this course, for courses in the future. Introduction to portfolio theory and all that. You must remember this corporate finance and all that. The higher the beta, more riskier it is. Not total risk, systematic risk. A has a higher systematic risk, B has a lower systematic risk. This guy is more riskier than the market. This guy is less riskier than the market. He has to pay the highest return. Has to, otherwise nobody will come to him. He's above the line. The line, the security market line that we drew, he's above, he is below. The line that we drew earlier on, this line. A is above M and B is below. Okay? Now, some people came along and said, wait a minute, one more time out. This risk-free asset makes no sense. That's a myth. Show us CAPM without the risk-free asset. And I've asked this many times in the exam. Is it possible to show CAPM without the risk-free asset? Or risk-free asset is essential. So we are removing one of the assumptions. One of the assumptions of the CAPM is the presence of risk-free asset. So these guys that did further work, and this is the same security market line we talked about, and they say, okay, so assume a portfolio Z. Total risk is positive. Total risk is positive. So this thing has total risk. But, big thing was, systematic risk is equal to 0. That means unsystematic risk is positive. The total risk is equal to these two guys put together. It's an assume an asset that has 0 beta. It's not risk-free, like RF. It's not risk-free, it has risk. Total risk is risk. In the end, it is risk. It's a diversifiable risk, but it's still risk. You said assume that. Assume, and this, tomorrow, Wednesday we'll talk about whether this exists or not. Total risk is positive, systematic risk is 0, and unsystematic is positive. So total risk is entirely made of unsystematic risk. It's entirely made of that. So in a well-diversified portfolio, this guy is going to have no effect. In a well-diversified portfolio, this guy is going to have no effect. And they said, in the same equation again, what difference does it make? Makes no difference. Theta is equal to 0. So Rz is equal to A now. So Rf. Rz is a return on the 0 beta portfolio. Market portfolio stays the same. B is now equal to that. Risky asset, you put A and B and you get a new equation, 4. No risk-free asset. 0 beta portfolio. There is no risk-free asset now. A 0 beta portfolio. So there you go. This thing is risky. Doesn't have systematic risk. It's possible to have something like that. But there is positive total risk. And the risk is entirely depends upon unsystematic risk. Why shouldn't that exist? Why shouldn't that exist? Tell us the reason why not. Beta is 0, beta is Z, beta of the zero portfolio is 0, will pay a higher return than the risk-free rate. The risk-free rate, standard deviation is 0. Risk-free rate has no risk. Beta is 0, systematic risk is 0, unsystematic risk is 0, total risk is 0. This guy pays higher return than the risk-free rate because it has risk. That's what they came up with. But, and that's the equation for the risk-free CAPM. Is a zero beta portfolio CAPM and same graph. And the question is, and I asked it before, does it exist? And we answered that on Wednesday.
What are you doing on Friday? Yeah, where do you go? Yeah, we go all over the place. Come out with us. We'll get you a drink. We owe you one. What's your number? Get my number. You have WhatsApp? I'm Jazz.